Let's talk about the dangers of low volatility, and if you must trade it, some golden rules to stick by so you don't get hurt. Stay tuned. Hey traders, warm welcome to you. Alright, so I've been stung by low volatility, low range, loads of times in my career. I can think of many years over the decades where I've tried to be involved with the markets when they're quiet, and it has never worked out. And I actually end up learning to learn the hard way. You do it, you repeat it, then you suddenly think, do you know what? Maybe I shouldn't be trading it. Now I'm just super strict. Low volatility, I just don't get involved in it because I know that that's not where my edge lies. I know that more often than not, even if I do manage to eke out something, it'll be hard work. I'm better off doing something else. So low volatility for me is to be avoided. But I know the process of thinking, well, why is it the case? Why are we not getting the same setup, the same patterns there? It's doing this, it's doing that. Why is it not as effective? And so here's some of the reasons why. And also, if you must trade it, I know some people perhaps are trading part-time, so they want the exposure to the market as well. I understand, but you've got to have some rules in place if you're going to trade low volatility, because arguably, and I would argue for the fact that low volatility can, especially for a day trader, be more dangerous than high volatility. Why? Because low volatility environments cause you to trade and trade to try to get something out of frustration, and then when that doesn't work, you get annoyed that you lost money in such a quiet environment, end up trading again, and it can ignite a cycle of kind of spiral into loss. Whereas high volatility environment, yes, you've got the danger of getting caught out, and if it just suddenly whips away from you and you haven't got any risk management in place, yes, you get hit, but you have opportunity to get it back if you can center yourself and trade. So that's my thought. Anyway, let's have a look at some of the things, guys. So why is it so dangerous? So the first thing is that it doesn't take much volume to move price. Because it's low volatility and low volume, and maybe we should distinguish actually between low volatility and low volume. I'm putting those together, kind of guessing that we're on the same page with that. So the market's just kind of chugging back and forth. Not necessarily, it could be low volatility like, yes, there's loads of volume and thick volume, and that's normal. Let's say maybe some sort of interest rate futures contract or something like that. But let's assume we're talking about a currency pair on index, low volatility, low volume. So it doesn't take much volume to move price. So because the benchmark is perhaps normally here for our trading volume, all of a sudden it's now here, it means that if someone comes in with an average size, all of a sudden that becomes way more than normal and can move price erratically, and it's quite difficult for us to get a read on it. Our reference point is X. If we're used to trading a market, all of a sudden something moves and we've got a different reference point because it's so quiet and stuff. So it's very challenging to get a read on it, and it moves price quite easily with lower volume. Whereas if you've got high volume coming in and sort of reasonable volatility, you've got more, the patterns are clearer. It takes more for the supply demand to shift. The other thing is big moves then get prolonged pauses. So very often you get these kind of spikes in price, and they stand out because of the lack of volume and the lack of volatility. And actually they're not really that much. They don't actually look that much when you kind of look at it in reference to every other spike across the month or the year. But actually on the day chart, the daily chart, or the intraday chart, it looks quite a lot. You're like, oh, it looks quite a lot, when really it's not. And so you get these big spikes and then it just sits there. So very often, this is happening super often, price will just be kind of sitting here. You get a spike like this, and then it'll just kind of sit here. Maybe it'll go high, maybe it'll go lower, and we fall into the trap, or we can fall into the trap. I think, oh, that's a kind of momentum coming in, it's a bull flag, or if you're looking for reversal or whatever, and trading off it. In reality, it's nothing. It's just this, whatever it was, order getting done, and really it's that price has just been kind of shifted up by that much. There's no pattern to it as much, and we often get these prolonged pauses, and that can suck you in because you can be buying that or selling that, and it just sits there and drifts, and it's super frustrating. Low liquidity causes price jumps as well. Kind of goes hand in hand here, because the liquidity is generally lower on the order book. It didn't take much. You and I can come in with a kind of reasonable size, obviously depending on the market, of course, but it doesn't take a lot for us to kind of move several price points. So institution comes in and just hits something at market, because the liquidity is much thinner in the order book. It doesn't take so much for it to jump up. So if you must trade it, my recommendation is always just to avoid it. I think it's better just to take that as a sign the market says, listen, take the day off. From trading, you don't have to necessarily take the day off completely. If you want to study your own trades, if you want to utilize that time in your trading business, then even better. If you want to take a day off completely, then fine. But I think it's one of those things that if it's low volatile, low volume environment, then just steer clear of it and just wait for it to kick back in. Times when we get these, we get these obviously over in the holiday period, like Christmas, sometimes over the summer, although the last few years it's been a little bit more exciting, but historically it goes a little bit quieter. A general rule of thumb, and it's a really general rule of thumb, is that when kids are off school in the US and London, etc., or UK should I say, then generally there's going to be people who are out of the office, and so stuff doesn't get done as much. You can stretch that a bit because very often, as I say, summer is active. Other times are if you're getting it before data, things like that. But anyway, if you must trade it, here's some rules. Look for extremes. So in other words, rather than just saying, okay, I want it to stretch to this level, I've said you've got a Bollinger Band or a Keltner, add another layer on, because you don't want to be taking the first kind of pulse up. That's not really an extreme, and it might well be triggering a Bollinger Band, because your Bollinger Band might be kind of running along here. That might be triggering it. Really, you want it to be triggering up here. So and if it's really, really extreme, you want to get involved in it, not when it's just doing this, because it ends up just sitting there doing nothing, and ultimately the Bollinger Band may catch up with it if you're using some kind of mean reversion thing like that. So look for the extremes. Be very broaden out your trigger criteria, entry criteria. Never chase price moves. This is, if you're going to forget everything else, this is the golden one, guys. Never chase price moves in a quiet environment. It will 9 times out of 10 be the worst thing you can do, because price will just sit there and stagnate. It might just continue a little bit, then back off. You're like, well, what do I do with it now? And when it stagnates, you're in a troubled situation, because you're maybe not hitting your stop yet. It's nowhere near your target. It's back and forth, and you're caught up in this thing which is just really not conducive to a profitable long-term strategy. The third thing is plan your moves. An easy way to kind of deal with it mentally, because of course we have the conflict on our mind of, hey, we should be trading this, should we be getting involved, and that does wear off over time. But let's say you're in that situation where that's still feeling like I don't want to miss out on anything, then plan what you're going to do very strictly, perhaps more strictly than you would normally do, and say, hey, well, this level up here is a level that I'd like to look to get short at, or I'd like to look to get long at. And just as an added thing, guys, be careful of shorting a quiet market. There's an old rule which says never short a quiet market, and generally that's the case, because generally if everyone kind of speculates throughout the market, then anyone's left in the market are people with the inflows of cash into mutual funds, etc., which are long only. So just another thing there. But so plan your moves. Say, hey, I will buy it, for example, if we stretch this level, and you might only have one plan, but at least then you're doing something about it, and you're saying, hey, this is what I want. Chance of me getting it, I recognise as slim, but at least I've got a plan of action. I'm trading it professionally, and then I can carry on doing some paperwork, some going through some documentation with my charts, my setups, my strategies, whatever else, and know that that alert may well go off. So plan it very strictly. Final thing, guys, is being very strict with your max loss rules. So again, try not to maybe get in this position, but just from experience, I just remember kind of 10, 11 years ago, getting caught out on quiet days where just dig a big hole, and you just think, what an unnecessary thing to do. You'd be trading it, it would be a poor trade, you'd get stopped out, maybe trade again with a bit more size to kind of counteract the fact it wasn't moving much. It'd sit there, you'd scratch it out, you'd get frustrated, and before you know it, you end up digging a hole for yourself, which really is just crazy. But guys, we're humans, I'm human, you're human, we make mistakes. Fortunately, as we go through our career, we recognize these and go, what are we thinking? And that's definitely something I wouldn't be doing anymore. But if you're in the situation where you're trying to trade it and stuff, just be very careful of your max loss rules. Like I say, best practice, I think, is not get involved in it at all. But if you do, say, hey, my max loss for the day or for whenever is X. And then when you hit that, get out of it and call it a loser. All right, guys, those are dangers of low volatility and some rules if you decide to get involved in it. Take care. See you in the next one. Bye-bye.